Saudi Arabia is paying Cristiano Ronaldo more than $200 million per year to play football in its domestic league. That single fact alone sounds unreal because it completely breaks the normal economics of sports. This is not a short-term signing bonus or a one-time endorsement deal. This is a recurring annual payment to one individual athlete, and this is only one example. Saudi Arabia has spent billions of dollars to host Formula One races, billions more to build a rival global golf league, close to $1 billion every year, to host premium wrestling events, and tens of billions of dollars acquiring stakes in some of the largest gaming companies in the world. At first glance, this spending looks irrational. It looks like a country throwing money at prestige projects without caring about returns. Many people ask the same question. Has Saudi Arabia completely lost its mind, or is this one of the most calculated economic strategies we have seen in modern history? Because countries do not repeatedly spend this kind of money unless something much bigger is at stake. In this video, we are not telling a motivational story or a dramatic narrative. We are doing a hard economic breakdown. We will analyze why Saudi Arabia is spending billions of dollars on sports and gaming, why oil dependence has become an existential threat for the country, how attention and distribution have become economic assets, and whether this strategy can realistically succeed in a post-oil world. To understand Saudi Arabia's actions, we must first understand the foundation of its economy. Saudi Arabia's economic model is heavily dependent on oil. Oil dominates exports, government revenue, foreign exchange earnings, and fiscal stability. For decades, this dependence worked in Saudi Arabia's favor because oil demand was strong and global prices were relatively high. Oil wealth allowed Saudi Arabia to build infrastructure, provide subsidies, and maintain social stability without imposing high taxes on its population. However, oil has two fundamental weaknesses. The first weakness is volatility. Oil prices do not move gradually, they swing violently. In 2008, oil prices crossed $130 per barrel. In 2020, prices collapsed to nearly $16 per barrel. Within a short period, government revenues can rise or fall dramatically. When a country depends on oil for a large share of its budget, this volatility becomes dangerous. It creates uncertainty, forces spending cuts during downturns, and makes long-term planning extremely difficult. The second weakness is structural. Oil is a finite resource, and more importantly, global demand growth is no longer guaranteed. Electric vehicles are expanding rapidly. Renewable energy costs are falling. Governments across the world are pushing climate regulations. Younger generations are becoming increasingly climate conscious. Oil will not disappear overnight, but the direction is clear. The long-term growth trajectory of oil demand is uncertain, and for an oil-dependent country, that uncertainty represents an existential risk. Saudi Arabia understands this risk very clearly. This is why in 2016, the country announced Vision 2030. Vision 2030 is not a branding exercise. It is a deadline. The goal is to reduce dependence on oil and build a diversified economy based on new sources of growth. At the time of the announcement, non-oil activities contributed only a small portion of GDP. That meant Saudi Arabia had less than 15 years to achieve an economic transformation that normally takes several decades. This sense of urgency explains the scale of spending we are witnessing today. Saudi Arabia is not slowly experimenting, it is aggressively deploying capital to accelerate change. But this raises another important question. Where is all this money coming from? The answer lies in the Public Investment Fund, commonly known as PIF. PIF is Saudi Arabia's sovereign wealth fund, and it controls assets worth more than $1 trillion. This fund is closely connected to Saudi Aramco, one of the most profitable companies in history. Saudi Aramco generates enormous cash flows from oil production. Instead of distributing all of this revenue as government spending, Saudi Arabia channels a large portion into PIF. PIF then invests this money across global markets. This strategy effectively converts oil underground into ownership above ground. Instead of relying on oil exports forever, Saudi Arabia is turning oil revenue into equity, platforms, and long-term assets. Sports play a central role in this strategy, not because Saudi Arabia suddenly discovered a passion for sports, but because sports function as global distribution networks. Football, Formula One, golf and wrestling attract billions of viewers worldwide. These audiences are emotionally engaged. They follow teams, players, leagues, and events with loyalty that few other industries can replicate. Attention in sports is global, repeatable, and deeply embedded in culture. Football is the most visible example of this strategy. Before high-profile signings, Saudi football had limited international relevance. Broadcast rights were inexpensive. Global viewership was low. Sponsorship interest was minimal. The league operated largely outside the global football economy. That changed when Saudi clubs started signing global superstars at salaries that European clubs could not match. Cristiano Ronaldo's arrival alone shifted global attention almost overnight. After these signings, global viewership increased significantly. International broadcasters that previously ignored Saudi football began bidding for rights. Global brands that had no interest in Saudi sports started exploring sponsorship deals. This was not about improving football quality in the short term. It was about buying attention, legitimacy, and distribution. Once attention exists, monetization opportunities follow naturally through broadcasting, sponsorships, tourism, and merchandise. The same logic applies to Formula One. Hosting a Formula One race is not just about motorsport. It is about visibility among global elites, corporations, and media. Saudi Arabia reportedly pays some of the highest hosting fees in the sport, but in return, it secures global exposure that few advertising campaigns could ever achieve. Golf provides another example. By launching a rival league with unprecedented prize money, Saudi Arabia disrupted a sport dominated by American institutions for decades. The goal was not short-term profitability. The goal was to force structural change. By offering financial incentives that traditional leagues could not match, Saudi Arabia compelled the industry to adapt and eventually negotiate. This is a classic capital-driven market entry strategy. Wrestling follows the same pattern. Hosting premium wrestling events delivers massive global entertainment reach. These events are watched by millions across continents. The cost appears excessive if viewed as entertainment spending, but it becomes logical when viewed as a distribution and attention investment. Gaming, however, may be the most strategic pillar of this entire plan. Gaming is not just entertainment, it is culture. It is where younger generations spend their time, form communities, and shape trends. By acquiring stakes in major gaming companies and investing in esports infrastructure, Saudi Arabia is embedding itself into the daily digital lives of hundreds of millions of people. This is long-term influence that extends far beyond sports broadcasts. Gaming also plays a critical domestic role. Approximately 70% of Saudi Arabia's population is under the age of 35. The traditional oil sector cannot provide enough jobs for this demographic. Gaming, technology, entertainment, and tourism can. These industries generate high-skill employment, attract global talent, and create opportunities for entrepreneurship. For Saudi Arabia, this is not just about global image. It is about internal economic stability. Critics often describe this approach as sports washing, arguing that Saudi Arabia is using entertainment and sports to reshape global perception. These concerns exist for valid reasons and deserve discussion. However, perception management does not eliminate economic logic. A strategy can simultaneously improve image and serve economic objectives. From a purely economic perspective, Saudi Arabia is converting financial capital into attention, influence, and ecosystem ownership. The real question is whether this strategy can succeed. This is an expensive and high-risk bet. There is no guarantee that sports, gaming, and entertainment can fully replace oil revenues. Global attention can shift. Consumer preferences can change. Competition can intensify. However, the alternative is far worse. Doing nothing guarantees decline in a world that is gradually moving away from fossil fuels. Saudi Arabia is betting that attention, culture, and global ecosystems will outlast oil. Very few countries have the financial capacity to attempt such a transformation, and even fewer can execute it at this scale. Whether this strategy succeeds or fails will have implications far beyond Saudi Arabia. It will shape how resource-dependent countries think about survival in a changing global economy. So the final question is this: is Saudi Arabia building one of the most ambitious economic transitions of the modern era, Or is it placing an oversized bet that could collapse under its own weight? I would like to know what you think. Share your perspective in the comments. And if you find deep, evidence-based analysis like this useful, you may want to stay connected for more videos that break down economics, power, and global strategy.